In part 1, you saw two main and basic categories of options trading. Bullish trend, where you can buy a call option or you can sell a put option to collect premium. On the bearish trend, you can buy a put option or sell a call option to collect premium. In this video, I will put those concepts into action, so it's easy to remember those concepts and see it in live charts. For this video, I will be using Webull, which I am using for certain options trading. This platform has got good technical analysis in charts. It's free to sign up. You can play around with all the features before moving cash for trading options. Since I have a login, I will log in with my email. It also asks for another verification to start the trading or see account details. Webull or any other trading platform, you will have to get approval for options. It does not get enabled by default. Most of the time, you have to go into your manage account and apply for options. I am just showing the details. I already have options approved for level 3. In this level, you can do a lot more options type. But we will be using only basic call and put, buy and sell. You can reapply for different levels after gaining some experience once you start with basic levels. Webull supports web version, which is also good. But the desktop version will have more functionalities. You can download the one based on your machine you have. I already have them installed, so I will launch it. I have lots of watchlist created. I will be using one of the watchlist where I have Apple stock. This is the chart area, where the 1-minute chart is selected. Let me navigate to the options tab. You can see, these are the contract expiry dates, which has got the date, month and year of expiry. It has got contract till June 2025. Not all stocks will have the same contract dates. Let's see the SPY contracts. If you see, it has got more contracts and also they have till December 2025. The closest ones also have number of them. Almost contract available for 3 years. Typically contract term greater than 1 year are called LEAPs, long-term equity anticipation securities. I will cover this LEAPs in later part. Let's get back to the Apple options. Click the contract which is expiring today. You can see it says 0 days. Apple is now trading at $129.93, since the market will close in few minutes. Most probably it will close around this price range. ATM, at the money, expiring contracts are ones which are within the 50 cents positive for a call and 50 cents negative for the put. The one in lightly shaded area are ITM, in the money, expiring contract, which will be assigned to the contract holder. The one in dark shade are called OTM, out of the money. These options will expire worthless. Meaning, if you are holding any of these strike price contracts, then they will be $0. You can see most of the out of the money contracts are almost showing 1 cent. In this tab, you can also select the other options types. But we will focus on the single call, put options. Even for this single option, you can display both call and put or just one of them by clicking these buttons. I personally prefer to have both. Let's now try to see all the options available. I will show the option contract price difference between the one which is expiring today, against a contract which is expiring 7 days from today. So, you will get an idea of the price difference on those contracts. If you see here, the at the money contract strike price $129, expiring today, is having a contract value of $75, versus the same strike price with 7-day expiry as $310. Also, if you look at the contract details, if it does have a W, which means it's a weekly contract, and the one which it does not is a monthly contract. The one which is very far away and greater than 1 year is called LEAPs, which we briefly touched upon earlier. Let's now look into the leverage of options with less investment and more profit. Let's look at the chart of Apple today. If you see here, Apple share had a good run of approximately 5%, which in value is almost $5 profit, if you had bought one Apple share worth of $125. You could have sold the same for $130, which is the peak it hit today. At the same time, let's say you bought the contract with 7-day expiring and you entered the trade at the same $125 strike price. Here you have invested $235, and if you had sold the same contract when the stock was $130, now you got $540, which is like almost 100% profit. Also, picking up the strike price also will vary in the profit percent. Out of the money contract will get more profit when there is a good upswing in a single day. This is called leverage. Please be aware that leverage can go the other way too. If you did pick the wrong contract, then you lost percent also will be huge. On that front, let's see if you had bought the put contract at the same $125 strike price today. Here you would have paid around $356 but ended up with $110. This is a big loss. I am not teaching the exit criteria in this course, but you should have a good exit criteria to minimize the loss in any trading. Let's also look into few more parameters, not going into those details. But just to get some fair idea, critical metrics like implied volatility and open interest are shown here. These two are very important to note, since implied volatility have impact on the options contract price. The more the volatile, the higher the contract price. Since you already know, buying a contract is like insurance. Say, for a home, if you are buying an insurance and your home is in an area where it might hit some natural disaster very often, then your premium is higher. Similarly, since the stock is so volatile, the options premium also will be higher. Open interest is another metric which is important. It's like the volume for the stock. The more the interest for the particular contract, you can get in and out of that trade very quickly. I also had mentioned earlier that out of the money contract will have higher profit. Let's say, if you picked up the contract which is expiring today and you picked up a $129 contract. Here you would have paid only $9 for the contract, but you could have made $130 out of that investment. It's almost 10x. But, trading a 0-day expiring contract is very risky and highly possible you will lose everything or get assigned the stock. Let's now see how to place an order. Let's pick up a monthly contract, which is expiring on the 20th of January. We have around 2 weeks to go. You can pick up at the money, in the money or out of the money contract. The out of the money contracts are cheaper. Let me pick up a $135 strike price call option. This is assuming that Apple will go up from here. Most of the details are already filled in, since you picked up from the table. You have to just specify the quantity, is this a limit or market order and is this order a day order, are good until cancelled order. Here also you can change the details if you want to. Let's see if we change the buy order to sell order. You can see that for the sell order, you are being credited with the amount. Whereas for the buy order, you are paying the amount. You can also start with a put option here and change later. Here this graph is very useful. It will clearly say how much the max loss and max profit you will make based on the price at expiry. Buying a call option is very powerful and will make you more money if the stock moves in the right direction as you expected. At the same time, the loss is fixed, which is just the premium you paid. This is the risk to reward you will have to play around with. Once you have filled in all the info, you can place the trade. Here, I have not unlocked my trading. Once you place the order, it will show up in this Orders tab. Also for the leaps contract and the ones which are closer, you can see the variation in the profit percent, since the more risker will have higher growth, since shorter contracts have higher predictability of where it might end up versus we do not know for the long contract. Okay, now you have got a fair idea on how to buy or sell a call or put option contract. But, will it not be good if you know what stock and option contracts are traded very high? Let me show you a website which will help you narrow down the list of stocks and contracts to trade. There are many websites which will provide you this info. I typically use barchart.com, which gives this info for free. But don't just rely on this, but you will have to do your own research. Even without login, you can get most of the top stats. It will require premium access to read more data. You can navigate to the options menu and can find bunch of option-related stats. Let's go into the options leader and see which stocks are having high options volume. You can see stocks like Tesla, Apple, etc. Their implied volatility, is that a put or call contracts and for which strike price? This will give an fair idea. But again, you will have to do more research to see why these stocks are traded high and play it accordingly. Hope you learned how to do a sell a call, or put, to collect the premium, for creating a regular income. And how to buy a call, or put, to use the leverage on the swings using less investment. Hope you enjoyed the video. Please subscribe to my channel if you like to watch similar videos and help my channel. Thank you, see you in another video.